This is Mike Swanson of Wall Street Window. You've probably seen a lot of headlines and stories about softening in the real estate market, uh, that prices in many markets in the United States appear to have lost some of their upward momentum. And as a result, there are many people out there predicting a crash in the housing market. For example, this is just YouTube. I type in housing market in the search, and what comes up? Videos like this: the largest housing crash is coming. Why sold? Zillow confirms housing market collapse. The housing recession has begun. Um, Mortgage rates now 7%. Real estate flip. Greatest crash ever. Avoid equities in housing until 2024. Harry Dent doubles down. Um, the start of the greatest housing crash forever. And this one is showing a CNBC clip. So it's not just the so-called alternative media that you see on the internet, but mainstream people talking about the potential of a crash in housing. Well, and there's a reason to be scared. Look, in 2006, there was a peak in a real estate bubble that resulted in a complete debacle. Millions of people became underwater in their homes. The mortgage market imploded. The real estate crashed as so many banks needed to be bailed out because of all this disaster. Well, I want to tell you that, look, these are predictions people make, but they're not basing them on anything solid that they're pointing at. They're just making predictions. And I've got a different take on where this market's going to go. Yes, I do think there's softness in the real estate market. The current economic data shows that that's the case in many places in the country, but not everywhere. Let me show you, for example, what we see and why people are worried. This is real estate in Myrtle Beach, South Carolina, and it soared as many places in the United States did, but it became one of the hottest markets. And unfortunately, it was one of the hottest markets in the 2000s, with condos being sold and speculators piling in. And then that market was one of the worst, much like the Vegas market, but this was one of the worst on the East Coast. And you can see here that the prices were around $200,000 for all homes, average price, in the fall of 2021. And 1 year later, 2 years later, the price is now over $300,000, a 50% return. And the gain last year, year to date, as of the end of July, was roughly 30%. Those are big gains in the real estate market. But and you can break it down. Look, the condo market, doubled basically from its lows of 2021. And when you go back to 2020, and it moves even bigger. But look, there's differences now than there were in the 2000s. An obvious example is we are living in a time of high inflation. This makes houses actually sort of, in some sense, a safe haven. When there's high inflation, which we're experiencing, we've had 9% annualized inflation as of the other month. Not seen since the 1980 or so. Houses become a solid, safe investment. Real world items are great investments in times of inflation. And the Fed has been raising interest rates as a result, but the interest rate is still way below the rate of inflation. That video where the guy was saying, oh, mortgage rates are 7%. Well, the inflation rate is still above that 7% rate. That will eventually change. And that is why we are seeing a softening in real estate prices. You can see from this chart, the prices have indeed, for the condos, come down from where they were in May to where they are now at the end of July. The prices for condos have come down. That is a sign of softening, and that's what is making people predict these crashes. Now, when you look at all home types, the price has gone up. Single family homes, the price has gone up. Townhouses, the price is off the high, but the single family homes, the price has gone up. But condos, so you see differences there. But one reason the prices aren't going to just crash is, as I said, what inflation means is that it costs more money to build a house. The condos come down more because there's more hot speculative money that goes into the condo market than it is someone building a new house that's serious about moving in. So different markets. But across the United States, the situation is similar. Now, this data, it doesn't update past May, but you can see massive rise in real estate. This is the Case-Shiller housing price index. In 2020, it was at 217,000. As of the end of May, 305,000. Almost, close to 50% over 2.5 years return. But yes, the prices nationally are softening too. However, that does not indicate just that fact, does not mean we can predict a crash. So how can we predict what real estate prices are going to do? Well, look, I've been investing in the stock market since the 90s. I once ran a hedge fund or co-managed a hedge fund in the 2000s. And I follow sorts of economic indicators. And when it comes to forecasting what housing prices are going to do, there's no more accurate indicator I've discovered than what futures contracts are projecting for housing prices. You see, yes, there are people that use futures to speculate, but there's also people that use the futures markets to hedge. So, for example, if you're constructing a home or buying homes to rent out, or you can hedge if you're fearful that the market is going to decline. People do this a lot in the oil market. This is what oil futures are due for, gold futures, but they also do it with housing prices. They can hedge if they think housing prices are going to drop for whatever reason. Well, those futures contracts are very accurate in projecting the future. So let me show you what they're projecting now is going to happen. This is the housing index futures, currently trading at 330. That's the average housing price that they are priced at, but they're pricing a decline to 315 in November, 300 in February, and all the way down to 288 by February 2024. That's a roughly 13 I'm going to calculate exactly what it is. Yeah, it's just want to confirm it. It's a 12.8% decline. From here, slow decline with a bottom, let's say, towards the end of 2023, somewhere in there. And maybe not. It's also projecting a bottom in August 2023, which would be, making it a roughly 10%. So 10 to 12% decline with a bottom somewhere from within 12 to 15 months from now. Slow decline, a 13% decline, let's say. That's not a crash. It just isn't. That's a small, slight recessionary softening in real estate. And a lot of people are saying we're in a recession right now. The two last quarterly GDP reports had negative prints. That's been the most commonplace definition that people use to say we're in a recession. So, and in recessions, normally housing prices do soften. So, and look, what happened in that 2006 to 2009 was a housing crash when it comes to the housing market, but that happened then. What about the recession earlier in the 1990s? or the 2000 to 2002 recession. There were housing crashes that happened then. And look, we had a recession after everything was shut down in 2020. There was no housing crash then either. So just because there is a recession doesn't mean there's a housing crash. And just because there's a slowdown in housing prices doesn't mean there's a housing crash. So don't be scared when people are saying, we're good, I'm predicting a housing crash. This is the most accurate indicator, does not suggest there's a housing crash. Now, look, let me show you what I do with the housing market. I like to trade REITs. These are real estate, or invest in them, real estate investment trusts. They own real estate. They're stocks, they're companies that own real estate and pay dividends to their shareholders from the rental income. And they trade on many of them trade on the stock exchange. And RWR is an exchange traded fund that owns a basket of these stocks. And it did crash in 2020 because the stock market crashed. And then it came back, and now it's trading with the stock market. It broke down when the market peaked in January. It peaked and it fell in May, June, and then it had a return rally back up to the green line on the chart, which is the 200-day moving average. Now, in bull markets, that moving average acts as support, meaning that once or twice a year, it typically gets tested to make for a great entry point to buy. In bear markets, the opposite happens. The market or the fund, the stock you're watching will fall below the 200-day moving average, rally up to it, and then stall out, and then trade below it, for a period of time. That's what this looks like it's doing. And look, when you're in a recession or approaching a slowdown in real estate, and that real estate slowdown really hasn't even, it's only kind of just off the high a little bit. We're not down 13%. So if that happens, it's evidence, further evidence that we're gonna have a recession, and it's not gonna be a crash, a collapse, the end of the world. But the stock market tends to be weak into a recession, which is exactly what it's done this year. The average investor in the market is down, through an analysis done of various brokerage accounts. I read 3 weeks ago, over 20%. It was like 22% year to date. Even they tend to lag. They underperform the averages, and so they got down more than the S&P because they tend to like to buy speculative stocks. Look at all the people chasing stocks like AMC, in Bed Bath and Beyond. Last week, the stocks whoop and then boom, because it was a pump and dump manipulation, and people get caught up in those situations when they see the stock market rally. But here we are, the market has already fallen into recession, which it typically does, and then it continues to go down in recession. So it looks like we're already started softening in the economy, and it's likely not to end until there is a bottom, the end of the softening in the real estate market. Not a crash, a softening. And that softening in the real estate market looks like it's going to end sometime in the fourth quarter next year or early 2024. So this is the environment we're in, and it's not something to be alarmed about, to be panicked about. In fact, depending on your situation, it may actually make sense to buy a home now, depending on the market, depending on if this is a home you're going to live in, because you've got to also factor in the reality that interest rates are creeping up, and that's going to continue. So that makes your payments more expensive to make. So I don't know. It takes a lot of math to figure it out. Is knowing that the interest rate's going to go up another % or 2, is that outweigh the idea that the price of the house may drop 13%? It could, depending on the price of the house, depending on where the house is located. And maybe if you're going to live in the house, think about that first. Buy something that's and make that your first priority. Is this a house that I really want? But when it comes to the stock market, it's more risky than real estate. Stocks tend to fall more when there's a recession than the housing market does. Houses fall 13%. They haven't even fallen 13%. The stock market already fell more than that. And yeah, it did rally in the past few weeks, but it's encountered resistance at that 200-day moving average. So I wanted to talk about the housing market trends in that, link that to the financial markets and the broader economy with you in this video. Look, I talk about all sorts of stuff. Talk about stocks, talk about news. I talk about politics, I talk about history. I talk about the real estate market. If you want more real estate market discussion from me, hit like here. And if you want to get my next video update, hit the bell and then, or hit subscribe. The YouTube button says subscribe below this video. Then hit the bell next to that. And then YouTube will send you a notification as soon as my next video is up for you to watch. And I'll be talking with you later.